कर दिया मैंने तो उसको बोला. Okay, this is a mic check. This is just a mic check. Can you hear us? Please. अरे यार, इस माइक्रोफोन तो म्यूटेड नहीं है सेटिंग्स में. कहाँ से आता है साउंड का? Sound. Just go here and type sound. Microphone. Microphone बंद है क्या?
नहीं चालू ना. क्या लगा माइक्रोफोन?
वो नहीं, वो छोड़ दो उसको मतलब
फुल है. फुल है.
हाँ. You can hear properly? Okay, ठीक है. Let's go back. Yes, sorry.
Guys, can you hear me?
Yeah.
Even if you can't hear, too bad. I think let's get it started.
They can hear you, sir.
Okay, wonderful. So let's come back with full energy and full force. Unfortunately, it's been a tough day for the markets and tough day for the IT systems, and we have just gone live with the IT system as well as with new enthusiastic regime of Modi 2.0. So we saw that the maiden budget of Nirmala Sitharaman and second budget of 2019 was not very well received by the equity markets, and equity markets obviously have been behaving choppy since then. But let's understand what's the reality. Let's understand what happened and what is the way forward. But before I delve into the budget nuances of the budget and what it means for the equity investors, let's go back in time, and I'm taking you way back in 1989. This is in Germany, when Germany was divided into two parts, East Germany and West Germany. Something happened in November 9th, which will change the way Germany will be for next 9 months, next 9 years, and perhaps for next 90 years. What happened? Let's understand this. So it was in the evening. At that point in time, as I mentioned, that Germany was divided into two parts, East Germany and West Germany. East Germany was largely a communist regime controlled by erstwhile USSR Russia and influenced by China, while the West Germany progressed well under the capitalist regime. Then zero. So you are not allowed to move. If you're in East Germany, you are not allowed to go to West Germany at all. But under the global pressure, that regime was about to get liberalized to a certain extent, where there will be a long visa procedure, and after that long visa procedure, some 80 to 90 visas will be issued to a few East Germans to cross over to West. A press conference was called, and there was a gentleman who was the minister, Gunther Schabowski. He was a minister in East Germany, and he was sitting in front of the audience, which was a bunch of reporters. And reporters asked, Mr. Schabowski, what's the next steps? How are you going to liberalize East Germany, and how you're going to make sure that East Germany follows the path of West Germany, and how you're going to do the visa regime? So in all confusion, he had a lot of papers. In all confusion, he said, this pressure and confusion, he said that we are allowing East Germans to cross over to West Germany. Immediately a reporter asked, from when this is going to be implemented? Again, under tremendous pressure, confusion, and he had obviously some health issues as well. He said immediately, just that single word, immediately. As soon as that word was stated, all the media channels started flashing that news all across East Germany and West Germany. Whole lot of people who were standing on the eastern side of the Berlin Wall jumped and rushed to cross over. On one of the gates where the chief of the security was standing, he didn't get any clear instructions from the superiors and the ministry in East Germany, and he opened the gate. As one gate opened, multiple other gates also opened. In next 9 hours, the Berlin Wall, which was dividing East Berlin and the West Berlin, will come down. In next 9 months, the East Germany and the West Germany will get unified. There will be democratic elections. And in next years, ladies and gentlemen, Germany will become one of the largest and the most prosperous economies in the Eurozone. They would lead all the initiatives of Eurozone. Now, what happened? Why am I telling you this story, and what it has any connectivity with Indian equity markets or budget? It's very, very simple. Sometimes we misinterpret. Sometimes we are not able to see the perspective. And that's exactly what happened in Germany. With some hand of God and with some confusion, Germany got unified, and today it is one of the biggest superpowers, one of the few nations which have surplus economy. Is budget 2019 reflecting the same thing? Perhaps yes. So the budget came in on a Friday, and after that markets have been taking 2 days of respite in last couple of days, but today again market gave up most of its gains. Why is market worried? Three major things. One is that more equity will come into the market because 25% of public ownership needs to move up to 35%. So the promoters have to dilute more additional 10%. Second thing, on the buyback of shares, the taxation has been increased, and on the buyback you have to pay 20%, which was earlier only the case in dividends. Third thing, markets believe that tax, FPI tax, which has been increased from erstwhile 35% going up to 42% is detrimental for the economy. So these are essentially three reasons why markets have been choppy and the way markets have been behaving the way they have been. But let's look at the other side of it. And I always believe one very simple thing. If you change the perspective, how you look at things, the actions which you take with a change in perspective also change. And when you change your actions, definitely the outcome also changes. And that's exactly what we need to do when we are analyzing this maiden budget of Nirmala Sitharaman. So look at from a longer term perspective. If 35% of the ownership is with the public, it means that minority shareholders become even more powerful. It essentially means that most companies have to do more transparency, more have to do things which are more towards the interest of the minority shareholders' interest, which essentially means in your interest and in my interest, in everybody's interest, right? Which means promoters' families can't dictate terms. They need to align themselves with the people who have given them money for future growth. And that's a great thing. The second thing, on the buyback tax. Essentially, there was an arbitrage where the dividends were being taxed whilst the buyback was not being taxed. Now, this is an arbitrage which is not very healthy, because essentially what companies need to do is whatever are the free cash flows, they need to keep reinvesting large part of it towards the further growth of the company. And that's exactly what companies are supposed to do, to ensure that the equity money which investors have put in should get reinvested back in growing the businesses, in ensuring that all the marginal money which is being utilized increases the ROE and ROCEs. And that's a simple way. That's a simple way of a small cap or a mid cap to become even larger. The third thing, government will let go of the fiscal measure. They will reach up to 3.6%, 3.8%, or some are even saying 4%. With this 3.3%, clearly the government has given a roadmap that the growth has to come, but not at the expense of leaving the fiscal prudence, and which is a very strong point for a country like India, which is growing at the fastest pace, and still we are cutting down our expenditure on the non-development side. Also, what it shows that rich and wealthy have to ensure that there is an inclusive growth. Large part of our society is still lower middle class or poor, and it is up to the business class, it is up to the entire rich elite class to ensure that everybody wins together. Because remember, whenever there'll be more disparity of income, there'll be more chaos, there'll be more civil unrest. And if you need a stable democracy, the differential between has and has not have to compress. And that's the reason the government has taken this move. Now let's look back some other interesting facts as well. We are worried where the markets are going to be heading. We are worried that how the economy will progress. Down, everybody. Why are you looking at short term? There is no reason to look at short term. Let's look at some data points, and these are very, very powerful data points. 10 years back, which I'm talking about 2009, since when immediately after the crisis and India bounced back, different regime. In last 10 years, India's GDP has grown almost by 98%. So India's GDP in 2009 was $1.3 trillion, and today we are at $2.7 trillion. 5 years back, we were at $2 trillion, and today we are at $2.7 trillion. So in last 5 years, Indian economy has actually delivered 35% growth. In last 10 years, Indian economy has actually delivered 98% growth. And this journey hasn't been smooth. So we have seen all kinds of reforms. We have seen change in government. We have seen highs and lows. We have seen demonetization. We have seen GST. We have seen how the capital markets have been flushed with funds in 2017. Despite of all that, Nifty in last 10 years has given returns of 280%. Indian economy delivered 98 to 100%, whilst Nifty gave almost 3x returns during the same period. In last 5 years, Nifty has given 73% returns, whilst the Indian economy has delivered 35% returns. Let's look at the mid-cap index. So Nifty mid-cap 150 in last 10 years has delivered 520% returns in last 10 years, and in 5 years 130% returns. So you can see that not only the large companies but the small companies also grow if Indian economy grows in their size in their fiscal measure. Very, very interesting to see the headline which government spoke in this budget. A $5 trillion economy from a $2.7 trillion economy, right? So almost a jump of 85%. Now, if Indian economy will jump in next 6 years or 5.5 years by 85%, you can imagine what can be the growth in Nifty and what can be the growth in the mid-cap businesses or mid-cap index. And that's exactly what I'm trying to tell you, that look at the direction which government is trying to build here. Some of the massive reforms which have been spoken in this budget, which includes your 1.25 lakh kilometers of Pradhan Mantri Gram Sadak Yojana. Now, we all understand that almost 60% of our population thrives on agri, consumes and receives income from the agri space. In fact, almost 55 to 60% of the population still stays in rural and towns, which are not semi-urban, which are relatively behind semi-urban areas. Now, if one has to ensure that these people tend to consume more, eat more, we have to ensure that their income rises. And how it can happen? By very simple things. Whatever they are producing needs to be sold outside where they are producing. And hence, road connectivity does three things. Very, very simple. One, it enables the person to go and sell outside. Second, it allows the outsider to come and develop the rural economy. Third, the road in itself creates employment and infrastructure spent in the economy, which enables all the sectors, including metals, including cement, including consumers, including labor, including construction, every sector, and the last man standing also gets benefited. Hence, this single initiative implemented in next 5 years can change the way India will grow. Imagine immediately after the budget, in next 3 days, already 28,000 crores of the third round of Pradhan Mantri Gram Sadak Yojana allocation has already been given a cabinet approval, which means government is very, very serious to ensure that the rural upswing is there. Another very interesting fact is that, as I mentioned, everything about 60%, 55 to 60% of the total consumer market in this country, which is currently a $1.5 trillion market, is from the rural sector. Now, $1.5 trillion consumer market, as per IMF and as per global agencies, is about to touch a $6 trillion mark by 2030, which means 4x in 11 years. 4x in 11 years. And if that were to happen, you can imagine about the large companies, the consumer-driven companies, the B2C companies, the companies which have been managed well, companies which have ensured that they are free cash flows, companies which are ensuring that their EPS grows year on year, continue to thrive and remain meaningful, not only for the consumers, but for the country at large. Very interesting thing which has also been said is 100 lakh crores of infra spend in next 5 years, which essentially means 20,000 crores of infra spend every year. Now that will drive the economy, but infra spend comes with a little bit of lag impact, and hence you would see benefit of this coming in another 2, 3, 4, 5, 6 months, and balance sheets will start improving. Another very interesting thing which government spoke about in this budget is zero budget farming, which essentially means that a common farmer without enough resources can still earn more and improve his livelihood. So what government is trying to do is to cut away the subsidies and remove the focus from the grain to the farmer. How can the farmer be sustained in a long-term growth and participate in India's economic growth? Can that farmer benefit out of it? Because remember, if this rural and the farm economy grows, the entire consumption, the entire Indian economy can grow in a meaningful manner. Also, to address the debt issues of the market, government gave 70,000 crores of capitalization to the public sector banks, which essentially means that banks are now gonna ensure that healthy NBFCs are being taken care of and they are being given lines in a regular fashion. Another 1 lakh crore of first charge 10% downside guarantee has been issued by the government for the public sector banks to buy the assets of the NBFCs, good quality NBFCs, so that there is enough liquidity with the NBFC segment. With all these measures, I clearly see that there is a direction in which government is hinting towards. What government is trying to do is cut down on the illicit money, ensure that segments which are not regulated gets well regulated but not over regulated. Things which were under the carpet are now being discussed and well spoken about, and measures are being taken care of. But why is stock market going down? The reason is very, very simple. What is ailing the Indian equity markets is simply the greed. So remember that the bigger issue in the stock market is not the budget. The bigger issue is not the growth of the country. The biggest issue is only twofold. Lot of NBFCs, lot of HFCs have gone long assets and short liabilities. Now, as a credit manager, the fundamental rule remains that you always have to be long liabilities and short assets. Because in a high growth economy like India and a reasonably well-placed inflation, assets are relatively easier to gather. But with a change in the credit environment, with a change in the global environment, sometimes it is possible that you have tough time in raising liability book. Hence, the fundamental rule which all credit managers have to stick by is long liabilities, short assets. But they have done reverse. The second thing which created actually the bubble of 1929 in US and 2008 is over leveraging. Over leveraging is always detrimental. And that's what has ailed again the corporate sector. Because of certain bad eggs, the overall sector is getting punished. And because of that, other sectors are being impacted. But what is the solution? The solution is simple. Government intervention beyond a certain extent will not change anything. It's a free market economy. You have to pay for your deeds. If somebody is greedy, you have to pay for it. And there will be consolidation. There will be alignment. There will be great assets which will come out of this little bit of pain which one is going through. But during that time, what you need to do is only look at companies which are less leveraged or where the corporate governance or the integrity of the management is very, very high. Because if you stick by businesses which are B2C, which are meaningful for India and which are meaningful for Indians, which do not have any political connectivity, which do not have dubious accounting practices, businesses which do not thrive on bureaucratic linkages or related party transactions, those are the businesses which will continue to do well now and they will continue to do well in future. Because India is going to become a $5 trillion economy. Whether it becomes in 2025 or early 2026 or perhaps mid 2024, nobody knows. Which means Indian economy is bound to grow. In other words, indices are bound to rise. The question is, how do you participate in this growth? The answer is very simple. Buy quality companies, buy quality businesses, buy good and clean businesses, and buy indices. And that's the simplest way one can make money in this market. Because if you keep chasing businesses where event risk is very high, if this happens, then the outcome will be this. If promoter will do X, then Y would happen. Won't fly. You have to buy businesses which are sustainable, where you have professional management. It really does not matter whether A is at the helm of affairs or B is at the helm of affairs. Process-driven businesses generally deliver growth, and that's what one should focus on. So, not in a nutshell, I would only want to articulate three very simple things to sum all the entire budget. One is, this budget is ensuring that there is a